Markets are crashing, portfolios are bleeding red, panic is spreading. What would you do? Sell everything and cut your losses? Or hold on and ride the storm? In this video, we'll uncover the strategies to navigate a market crash like a pro. I'll show you when to stay invested and when it's time to exit, so you can not only survive but thrive during turbulent times. Stay tuned, because the next 8 minutes might redefine how you think about investing forever. The problem? Fear and uncertainty. A market crash isn't just about numbers, it's about emotions. Fear takes over and people start selling without a plan. But let me ask you this, when everyone is panicking, do you join the crowd or stand apart? Here's the thing. Historically, crashes are temporary. Remember 2008? The market fell 50%, but those who stayed invested saw their portfolios recover and grow beyond expectations. Imagine selling your stocks out of fear only to see them double in value 2 years later. Ouch, right? Let's make sure that doesn't happen to you. The framework. Invest or exit. Point 1. Assess the situation. First, step back and assess the situation. Is this a market correction or a full-blown recession? Corrections are common. Think of them as the market taking a breather. But a recession? That's when you need to dig deeper. Look at the reasons behind the crash. Are they short-term shocks, like geopolitical tensions, or long-term structural issues? Understanding this is the first step to making a rational decision. And here's a twist. Sometimes, a crash can be your greatest opportunity. More on that in a moment. Point 2. Review your portfolio. Next, evaluate your portfolio. Ask yourself, are your investments fundamentally strong or were they speculative bets? Strong companies with solid balance sheets often bounce back after a crash, but over-leveraged or trendy stocks, they may not recover. Think of your portfolio like a sports team. Would you keep players who underperform every game or invest in consistent all-stars? Exactly. Point 3. Timing your decisions. Timing is everything. But here's the catch. No one can perfectly time the market. Not me, not you, not even Warren Buffett. Instead, focus on dollar-cost averaging. Invest small amounts consistently, regardless of market conditions. This way, you lower your average cost per share during dips. But what about those stocks that keep falling no matter what? How do you know when to let go? I'll answer that in just a bit. Point 4. Emotional discipline. Let's face it, emotions are your worst enemy during a crash. Fear and greed drive impulsive decisions, which often lead to regret. Create a plan and stick to it. Set stop losses for your speculative investments, but hold your strong assets with conviction. And remember, every crash in history has been followed by recovery. The question is, will you be on the sidelines or in the game when the market turns? Speaking of emotions, ever notice how we're fine losing money on pizza delivery but freak out over a 5% dip in stocks? Let's get our priorities straight. The payoff thrives, not just survive. So, should you investment or exit? The answer lies in your strategy. Don't panic. Assess the situation, trust your research, and make disciplined decisions. Crashes aren't the end, they're opportunities in disguise. The best investors don't fear them, they embrace them. And if you're ready to learn how to turn these opportunities into long-term wealth, check out this video on the power of compounding. It's the ultimate strategy to grow your wealth exponentially over time. Click here, and I'll see you there.